Hello, investors. So, we are back again with another topic, which is not actually something which is related to value investing, but still, I believe that this is of importance as an investor because, from the perspective of diversification, risk mitigation, and even a consistent return point of view, rates are very important. So, what is a rate? How is it different from a real estate investment? So all these things we would be covering today in our video. So REITs are nothing but Real Estate Investment Trust, REIT. So what is a REIT? Before discussing about REITs, at least in India, I will discuss how these REITs are introduced and where it is first introduced and such details. So REITs were introduced first in US in early 1960s. In India, if you see, it was launched by SEBI only in 2014. So compared to foreign market, in Indian market, it is very new. REITs like mutual funds operate real estate properties, generating regular income and even capital appreciation in a steady, comparatively slow pace. REITs are nothing but investment trusts, as the name indicates, that pool money from investors, and REITs usually has got a trustee, a sponsorer, and a manager. So that is the basic structure of a REIT. So again, getting deep into this topic, REITs are just like mutual funds for real estate investing. So what do I mean by that? So mutual funds, you can see, unlike a stock, mutual funds has got units. It has got a net asset value, which otherwise is called NAV. And once you buy, say, for 3000 rupees, you invest into a mutual fund, then you will get equivalent units for the 3000 rupees you invested in it. So every time you buy, say, in an SIP, or even in that case a bulk investment, you get units of that particular mutual fund into your portfolio. So that mutual fund can be a debt based mutual fund, or even it can be equity, wherein if it is an equity mutual fund, then you have got lot of stocks listed in that, blue chip, mid cap, whatever the type of, based on the type of mutual fund it will vary, but still it has got a large portfolio of stocks, bonds, and other instruments. So similarly in rates, if you buy it, you are getting units allocated against that. You can invest in a REIT without actually owning a property physically of your own, unlike a real estate investment wherein you buy a residential or a commercial property. So from tax point of view, physical real estate investments still holds good. You can utilize this to reduce your tax slab by filing tax rebates on this regard. So you already know, if you buy a home, you may get it on home loan. So the home loans are eligible for tax rebates. So you can wisely save on tax, or maybe you can reduce your tax slab by showing your investment in real estate, that is in your case home loan, and that whatever you get as a tax rebate, you are getting it back from the government while you file it. You are getting an exemption on your income. So such tax returns are not actually available in rates, though you are indirectly investing in properties. Unlike a physical real estate investment, rates are not tax efficient. In a real estate investment, we get either rental income, appreciation, or profits generated from any business activities based on the type of the real estate we hold. So that is well known to you. But in real estate, you have the disadvantage like finding quality and consistent tenants whom you can rent the house or property to. You can have loan defaults because you have taken the flat or the property on loan, and if you are not able to pay back the loan, then you may have a default and you may eventually lose the property. Also, the maintenance activities, these are like sort of headaches for physical real estate investments. Also, real estate is not that liquid as an asset. Means selling out the property you own takes sincere efforts, especially in case of an emergency. In fact, in emergency, you have to sell your property at a lower price, since the buyer takes its due advantage of your emergency situation. In real estate, however, you have control over all the decisions related to it, unlike a REIT, which is managed by a REIT management team. So you cannot directly involve in the day-to-day activities or even the management of the properties you have owned through various units bought through a REIT investment. But again, I would say it is better that you leave the property management to the specialist in the REIT team rather than you looking into it. What I am bothered about is only the returns you fetch from a REIT. REIT, on the other hand, is a corporation that owns, operates, or finances income generating real estate or real estate related assets, which already we have discussed earlier. REIT pool the capital of large number of investors like us. In India, REIT, being comparatively new concept, is having only 3 listed players, which in countries like US, where there are more than 225 REITs listed in the stock market. More than 35 countries worldwide offers REITs. REITs are safer, low risk assets as they are managed by expert managers. In Indian REITs, since a year now, you can even buy lower number of units, unlike earlier, wherein while introduction to Indian market, larger lots were to be bought as the rule set by SEBI to avoid low capital retail investors from unforeseen risks. Because rates were introduced, as I told, in 2014, and Indian markets were new to that, and whatever the possible risk which it was holding, nobody was aware. So though it is proven in other markets, so SEBI didn't want to take that risk, so this rule was brought in. But now that it is proven in our market more than 7 years, they have removed that criteria of larger investment requirement. And another interesting fact to note is that rates can be very sensitive to interest rate fluctuations. Rising interest rates are harmful to rate prices. Rate prices and bond yields are inversely proportional. Also, majority REITs are not diversified as in itself. As mentioned above, in Indian listed REITs, they have invested mainly in commercial spaces alone. That's like offices or shopping malls, and not into apartments, hotels, etc. 90% of the earnings, that is the rental income, is given back to the investors as dividend, which is taxed. So it can be taxed at source, or tax can be carry forward to you as well based on the company of rate which is offering it. So 90% means whatever rental income they are getting from the properties they give out to the commercial owners, so that is given back to us as a dividend. So rest 10%, you would be wondering where it is going. So yes, they are managing it for us. So the 10% is taken as their charges. You can say the expenses and charges and everything. So that 10% goes like that, and only the 90% comes back to us. So again, you take an example, say in Pune, you have a IT park. So IT park has got lot of companies like TCS, Infosys, whatever. So many companies may not be able to own that property, or it doesn't in fact make it sensible to own the property by themselves, because based on the various conditions. So if they want to cut down some population, so they can reduce the number of employees. So if they are reducing the number of employees, if the property is very large and occupation, and it is accommodating lot of employees, and if such say 30% of employees is cut down, then there is a risk that assets remain unutilized, and there is no end of the day, there is no point in maintaining such large assets which doesn't generate any profit to the business. But in case of a rate, if the company rents that place, and if in such cases wherein they decides to cut down the operations or move on from one state to other, so they can easily stop paying the rent to the rate company and go for other rate company to another state or another place, again restart the business based on their management decisions. So these rate companies also yearly or even in a few years, they keep investing or they keep acquiring new properties, and again build lot of properties and build commercial buildings in that, and again rent it out. So this is how the rates work. And again rates are very safe because there are various rules set by SEBI. I am not in detail getting into those rules because it is available everywhere. Like there are some rules like you cannot keep a property which is not utilized or which is not rented out or which is not generating any income. So it's like the rates company is getting money from us investing in a property, and they are not building anything there and they are not renting it out, then that's a dead asset, like our money will not grow. But there are again strict rules by the SEBI and other investing agencies which tells that a large percentage of the property which is owned shall be rented out and shall be generating income for the investors, and that is again risk mitigation. And another interesting fact is that this renting out process, in that say a rate is renting out a commercial property to company A, so the company A will be making a contract with the rate not just for a year, so it can be for 5 years, it can be for 10 years, it can be even for larger number of years. So another factor to see while evaluating a rate is that what is that contract period, the average contract period of the complete properties which is been rented out by that rate. So if it is like above 5 years or above 8 years, you can be really sure that income generating from such rates will be good. Why? Because if in this case of pandemic, last 2 years has gone as pandemic, so the rate companies, if they had rented out without any larger contract, say for 1 2 years, then it has been very difficult for the rates because majority of the companies were working from home and all. So they would have stopped giving the rents and would have told rates that we are no more needing your property. But as these companies already have paid out for 8 or 10 years, even though the employees are coming or not, they are supposed to pay rent to the rates company. So that is the advantage of long term contracts. So from all these things, it is very clear that the rates are really safe. Rates are even liquid, unlike real estate. Like you can sell and buy rates just like a mutual fund or a stock. But you need to know that rates, unlike a stock, is not that liquid. It is not traded much. So you can see the price of the rate in the market will not be so much volatile like a stock. So its growth is really very steady. So the rates which are listed in India, you can see on the screen. So these are the three rates which are listed in India. They invest in commercial properties like office spaces and office campus. So at least in all these REITs listed in India, I have seen that we get around 5.5 to 6.5% of dividend income from these REITs. So again, you would be thinking, why just 5.5 to 6.5 or even 7%? So this percentage is much high compared to a real estate investment. Like if you own a home and if you are buying it for some amount and you are getting a rental income from that property, considering all the maintenance and society charges, you remove that, and whatever you get effectively in your hand after taxes, that amount is much lesser than what you get here. So that amount is, as per me, it is something around 4.5%, and here you are getting 6.5%. So it's clearly at least 2% more than the at least the home you invested in. So this is again dependent on where is the locality of the home and whatever returns you are fetching from that. But overall, my study says that real estate investment trust gives us more returns and also mitigates risk of physical assets and maintenance cost and tenant issue and other headaches, and it is easily liquid and you can sell off such units very easily. So these days, in case of high uncertainty, I suggest you to invest in REITs wherein you fetch fair returns in comparison to flats, and the EMIs for the probable loans taken to own that flat or property can be invested through SIP route in quality mutual funds, again to get decent returns year on year. Even quality stocks can be monthly invested in through SEP route, systematic equity plan. Good ETFs are also to be looked at for monthly systematic investment. So if you have a flat to live and if you are looking for a new flat to buy, don't, as per me, don't buy a new flat. Explore such investment instruments and really you will get good returns. Normally, I have seen that when the market crashes down, rates hold its value and does not correct deeply, helping in diversification and helps whole portfolio from getting into deep losses. I will see you in the next video. Happy investing.